Welcome to this RE pre-study lesson, which provides an introduction to regulation in the financial services sector. Regulatory exams test knowledge of two frameworks, the Financial Advisory and Intermediary Services, or FACE Act, and the Financial Intelligence Center Act, or FICA. This lesson focuses on contextualizing the FACE legal framework. The FICA framework will be covered later. A legal framework consists of mandatory standards and legal guidelines that guide decision-making in specific areas of society and the economy. A legal framework creates boundaries in the form of responsibilities and freedoms in the form of rights. A legal framework is made up of three components: main act of Parliament, subordinate legislation, exemptions. In compliance, decisions must always consider all three components of the legal framework. The Financial Sector Conduct Authority, or FSCA, is the FACE Act regulator. Any country can broadly be divided into two main spheres, the social sphere and the commercial sphere. Governments regulate these spheres either by enacting legislation or, in some cases, by allowing self-regulation through the creation of an appropriate regulatory environment. In South Africa, the social sphere is regulated within a strict legal framework, with the Constitution of the Republic of South Africa as the highest law. The Constitution primarily protects democratic rights. Within this constitutional framework, self-regulation applies to many aspects of social life, provided it remains consistent with the principles of democracy. The commercial sphere relates to the economy and includes the manufacturing of products and their distribution through marketing. This sphere can be divided into product manufacturing and product marketing. The commercial sphere operates largely within a free market system, which is a form of self-regulation. Individuals have the right to participate in the commercial sector either as businesses or as employees. In a free market economy, decisions relating to production, supply, and pricing are mainly determined by supply and demand. Government's role is to create and maintain an environment in which this system can function effectively. In a free market economy, government does not usually intervene directly in what manufacturers must produce or how products are priced. Government may, however, intervene through manufacturing standards, product standards, and consumer protection laws to ensure product safety and to ensure that accurate and fair information is provided to consumers during the marketing of products. A product can be described as a concept that promises a specific output performance in return for an input performance by the purchaser. Roles in a product transaction. The manufacturer is responsible for delivering the promised output performance. The purchaser is responsible for delivering a monetary performance in the form of payment. The marketer is responsible for providing accurate and appropriate information regarding both the input performance, such as price, and the output performance, such as return or benefit. Therefore, every sales transaction involves three parties and two distinct legal relationships. There is a contractual relationship between the product maker and the purchaser, and a contractual relationship between the marketer and the purchaser. In the relationship between the product maker and the purchaser, input performance and output performance may occur either immediately or at a later stage. Based on the timing of these performances, products can be classified into three distinct categories. These concepts can be consolidated by considering the three categories of products found in the commercial environment. The first category is ordinary goods, such as televisions or canned food. These involve a now-for-now transaction, where both parties perform immediately. The second category is financial products, such as insurance policies and investment products. These are now-for-later transactions, as the product supplier promises to perform financially at a future date. The third category is credit products, such as loans, which must not be confused with financial products. Credit products are later-for-now transactions. The credit provider performs immediately by advancing funds, while the consumer performs later by repaying the loan over time. Ordinary goods are manufactured by manufacturers and are regulated by free market principles, contract law, and product legislation to ensure proper performance. Their marketing is governed by common law and consumer protection legislation, such as the Consumer Protection Act, which requires accurate information and transparent pricing. If incorrect information is provided, the seller may be held liable. If the product fails despite correct information, liability rests with the manufacturer. Financial products are not manufactured, but issued by product suppliers. They represent a promise to perform financially in the future, while the purchaser performs immediately by paying a premium or investment amount. The issuance of financial products is regulated by sectoral legislation, such as the Insurance Act and Banks Act, while the marketing of financial products is regulated by the FACE Act. A business that markets a financial product acts as a financial services provider. Credit products differ from financial products. In a credit transaction, the credit provider performs immediately by advancing funds, and the purchaser performs later by repaying the loan. Both the issuance and marketing of credit products are regulated under the National Credit Act. Ordinary goods are manufactured by manufacturers and are regulated by free market principles, contract law, and product legislation to ensure proper performance. Their marketing is governed by common law and consumer protection legislation, such as the Consumer Protection Act, which requires accurate information and transparent pricing. If incorrect information is provided, the seller may be held liable. If the product fails despite correct information, liability rests with the manufacturer. Financial products are not manufactured but issued by product suppliers. They represent a promise to perform financially in the future, while the purchaser performs immediately by paying a premium or investment amount. The issuance of financial products is regulated by sectoral legislation, such as the Insurance Act and Banks Act, while the marketing of financial products is regulated by the FACE Act. A business that markets a financial product acts as a financial services provider. Credit products differ from financial products. In a credit transaction, the credit provider performs immediately by advancing funds, and the purchaser performs later by repaying the loan. Both the issuance and marketing of credit products are regulated under the National Credit Act. To summarize the key points, a legal framework comprises mandatory rules and guidelines that create rights and responsibilities. Every legal framework consists of three components: the main act of Parliament, subordinate legislation issued by the regulator, and exemptions where regulation would otherwise overlap or result in overregulation. In the commercial environment, every product transaction involves three roles: the product maker, who delivers the output, the purchaser, who pays, and the marketer, who provides information. This creates two legal relationships, one between the product maker and the purchaser, and another between the marketer and the purchaser. Products are classified according to when performance takes place. Ordinary goods are now-for-now transactions, where both parties perform immediately. Financial products are now-for-later transactions, where the client pays now and the product supplier performs financially in the future. Credit products are later-for-now transactions, where the credit provider performs immediately and the consumer repays over time. Financial products are structured and issued by product suppliers and are marketed or serviced by financial services providers. The issuing of financial products is regulated by sectoral laws, while the marketing of all financial products is regulated under the FAIS Act. Finally, it is important to remember that the law regulates businesses based on the role they perform in a specific activity, not on their business name or overall operations. A single business may therefore perform multiple legal roles, depending on the transaction involved.